Now, in 2021, what was kind of interesting about that year, of course, as we noted earlier, you had kind of the sector rotation, you had the tech wreck, a lot of these, Shopify's and PayPal and Zoom, DocuSign, basically anything that was great during the COVID recovery was doing very poorly in 2021. But the indexes were still doing great because the mega caps were kind of carrying it forward. And so even though you had most stocks declining, the mega caps were making the indexes go up. So when you kind of get a disconnect, especially easy to do now with the mega caps holding so much weight in the indexes, does that alter how you play things at all? Does that ever
Yeah.
cause problems for you?
It causes big problems. As you were describing that, I got a little pit in my stomach just remembering how difficult 2021 was. Because to
I'm
your
sorry, I didn't
point,
mean to do
no,
that.
no,
Like,
that's okay. It's a good thing to bring up, right? Because it was a learning lesson. And I can tell you some little tweaks that we've made as a result of that.
okay.
Um, so yeah, so we had a situation where a lot of those leading stocks, we're always looking for market leaders and market leading areas, and a lot of them started to come under significant pressure in 2021, while the major indices were holding up just fine. So if we are looking to short things like the SPY and the QQQ against that basket of stocks, it wasn't doing, a very good job because we were seeing pressure on the underlying stocks, but not a lot of benefit from the hedges. So 21 proved to be a difficult year for us because of those aspects and those relationships that you were just describing. And so, as we got together and we looked at 2021 and we said, what can we do better going forward so that we don't have that sort of occurrence again? One of the things that we chose to do was we had been relying a lot on those index ETFs as shorts, things like the SPY, QQQ, IWM. And we chose to expand that to include a lot more of the sector ETFs
Yeah.
and
Yeah.
even some of the industry ETFs. So, so starting this year, we started to expand it and using those much more. So we've been able to short things like, the fintech ETF or the cloud stack ETF, or things that we can adjust our exposures within the portfolio a little bit better, and we can kind of express them, in a more direct way.
Well,
Oh,
then I guess maybe as a follow-up question to that, just how did that kind of play out maybe a little bit better than in 2022 to maybe get rid of that pit in your stomach?
Yeah, no, I mean, it's played out much better this year, especially in the beginning of the year and during these periods when we've seen these really rapid market drawdowns. Having that flexibility to target, those specific areas have really helped offset exposures elsewhere within our portfolio. It's been a great benefit.
hmm
so for the long ideas, what are some of the screening criteria that you use to find ideas for the individual stocks?
Yeah. So our primary method of screening, this is what we call our initial phase of our screening process, is we search for what we call meaningful breakouts. And really what that is it's high volume breakouts, right? So it's not just a breakout in price. It has to also be accompanied by, 2 to 3 times spike in average daily trading volume. And interestingly, one of the screens that we use is actually one of the MarketSmith screens. They have one of these breakout screens that we run on a daily basis, which is one of the ways that we get a list of stocks. And then from there, so we get this list of stocks that are having these breakouts, and then we kind of whittle it down from there and do our deeper dive by going into more rigorous fundamental analysis, looking under the hood of these companies and looking at earnings and sales growth and the sustainability of those, earnings stability, profitability, free cash flow, all these other things. And so what we're really trying to do with this second phase of our screening process is kind of only focus on the highest quality companies that are coming through the first stage. So we're really trying to weed out kind of the pure momentum stocks that might come through. Maybe they have no earnings or egregious valuations or things like that. Because in our work, what has really helped to identify the real market leaders has been focusing on these high quality fundamental companies, but ones that have also experienced those high volume breakouts. And together, those things can do a good job of identifying market leaders. And so that's kind of how we build our portfolio on a bottom up basis using, that initial screen and that second deeper dive. On average, we hold about 30 to 50 names in our portfolio. And again, we're style agnostic and sector agnostic. We're just trying to build up a portfolio of the best ideas based on those criteria.
Isn't that sometimes too late if you're seeing the stock on a breakout, then you're doing the due diligence? Aren't you going to miss a number of those stocks if you're in a great market, they might just start running away from you?
I mean, yeah, we have to act quickly. So,
Okay.
our initial due diligence, we have a screening process that we can get through pretty quickly,
Okay.
usually in the matter of sometimes the same day or in a couple days. We're at least starting an initial position, and then we'll look for spots to add on to it.
Got it. Okay.
Hmm. Now, let's maybe dig a little bit deeper into the fundamental side, since that's kind of where you started with that fundamental analysis. How do some of these aspects come into play? Like, for instance, it seemed like in 2018, for a few years, wow, you know what? Earnings don't matter. It's all about that heavy revenue growth. Triple digit revenue growth. Who cares about earnings? A lot of times, we don't tend to care about PEs, but right now the market certainly seems to care about PEs with interest rates getting higher and everything. So, do any of those things come into play of, oh, you know what, we need to adjust for this market environment, the fundamentals, one way or the other?
Yeah, we try not to make too big of adjustments based on just, uh, market whims at any given time.
Hmm.
Like for earnings, as an example, we tend to, while there may be one or two or a few names in the portfolio that don't have earnings that we think are going to be profitable in the near future, for the most part, we do try to focus on companies that already have profitability. And then, to your other point about things where the market is focusing, that's where we really look at our breakout screens, and we kind of will let the market tell us where it's placing value,
Yeah.
amongst the different sectors or different areas in the market. Because as we start seeing more stocks breaking out and coming through our screens from certain areas of the market, that's where we tend to see, oh, the market's placing more emphasis here, and that's where we're seeing leadership, and we can focus on that a little bit more.
What about options? Now you did your master's and you learned tons about options. Are you incorporating that into the strategy too?
Yeah, so we're fairly active with options, on kind of on two fronts. One is sometimes if the market has run up a lot and volatility has gotten low and options are cheap, we will employ some index options in the portfolio just to kind of have a little bit of a hedge in there. So whether it's SPY put options or QQQ put options, something like that, we do that on an occasional basis. And what we do more frequently is we will use put options on an individual stock. So
Okay.
if a stock has had a big run up and maybe they're going into an earnings announcement, we'll buy puts on that stock just to kind of hedge against that event risk. And sometimes it's just a market call. Maybe a stock has had a big run up and we've trimmed the position, but we also kind of want to put a floor under it, in case of that big retracement that you often see.
Yeah,
And so
yeah.
we'll use put options in that instance as well. So we're fairly active on trading around our put positions as well.
And can you describe that a little bit more, like some of the details? So, are you kind of going with, at the money options, with kind of like a 50 delta, or are you just trying to protect yourself from a big downside move? So you're kind of going a little bit further out. What's kind of your strategy there?
Yeah, so to your point, the deltas do come into it. It's a big factor in it. So on a daily basis, any put positions that we have, we're always delta hedging against our long exposure, right? So I don't want to get too far into the weeds, but you know what I mean. So at a
Hmm.
50 delta, like you mentioned, you'd have to buy twice as many puts as
Right.
you have underlying common. So we're always kind of adjusting that relationship. We tend to start with those at the money puts that are roughly around a 50 delta, maybe slightly out of the money on the downside. But then if the stock does start to move down and go in the money, if we get 5, 10%, 15% in the money, we'll also take profits on those puts and roll
Hmm.
them down to a further strike, just so that if the stock bounces and goes back up, we've kind of taken some profits and limited our losses on that side of the equation as well. Does that make sense?
Yeah. Mhm.
Well, and how far is the time frame? Are you using weekly options, monthly options? Do you give yourself enough time on that?
Yeah, when we're buying options, we like to give ourselves a little bit more time just to kind of offset that decay that you can see in
Right,
options
right.
prices. So when we're buying options, we tend to go 2 to 3 months out.
Okay.
And then we're fairly active. We don't usually plan on holding them until expiration. We figure we're going to trade around them in that
Mhm.
time frame, but we want to give ourselves enough time that we don't have that immediate decay. If
Yeah.
we're selling options, right? If we ever sell calls on a position or something like that, then we want to be much shorter, usually measured in a number of weeks, not months.
Mhm.
Because
And
in that case, we want it to decay quickly.
right, you want the
Exactly. Yeah,
decay.
yeah,
So,
yeah.
and in what situations are you selling options? You mentioned the covered call. Is that pretty much all you're doing, or is there times that you're selling puts as well?
We never sell put outright. I never think that that's a good strategy at all. The only time that we will sell puts would be in a combination with buying a put, so doing a put spread. And I think
Right.
this is kind of important for the novice investor or somebody who's just getting started in puts to understand, is that when you are in a high volatility environment, and the VIX is high and implied volatilities are high, the prices of options can get very pumped up. And it can be difficult to make money because the premiums that you pay, it can come in quickly. So if volatilities are high and we think that put options are expensive, in that case, we'll usually use a put spread, meaning we'll buy a put, but then we will sell a put at a lower strike. Just so if there is that sort of, decay, or if the premiums come in, we have that short one there that we can make money on that decay quickly, while still having that downside exposure from the long put option.
Right. And reduces your cost, especially when you've got those high prices on the premiums. So
Exactly.
that's the little option discussion.
Yeah, exactly. It was like,
Yeah, that's great.
Yeah.
And anything else about your strategies that, again, we've already touched on a lot between the exposure thing, and maybe it would be a little instructive for you to kind of maybe throw some rough amounts at different areas, like, when we were at the June bottom or October bottom, like what was kind of your exposure target between your stock exposure and the hedge, to give you that overall exposure.
well, before you get into that, maybe the cash exposure,
Oh,
because
yeah, that's a good point. Yeah.
we were talking earlier
Yeah.
about relative books and things like that. Uh, how much cash do you guys go to? A lot of funds, they limit themselves to 5% cash or 10% cash.
Yeah.
How far? How flexible are you guys?
So we're flexible. We actually don't have any sort of cash constraints in our portfolio. So, in theory, we could take cash as high as we felt was relevant.
Yeah.
I think that the highest cash that we've had is probably around, 60, 70%, because what's more important to us is the overall exposure in the portfolio. So like I mentioned to you, we have our stock portfolio that, is a certain percent long, and then we will offset that with our ETF hedges to bring it down, as well as any put options we might have. So when the market was at its low points this year, and our hedge model was dictating 0% exposure, in practice, what that would mean was taking our stock portfolio down to 50, 40%, somewhere in that neighborhood, and then having our hedges equal the same 40 or 50%, so that our net exposure was all the way down to zero.
Okay.
So, the fact that cash had gotten up to 50% wasn't necessarily by design. It was more just because we had cut back our stocks and increased our hedges to get that net exposure down to zero, and the sale proceeds, just went into cash.
Yeah, you're listening to the market, right? So
Yeah.
And then I guess that begs the question: do you ever go net short?
So in the situation that I was just describing to you, where we reduce our stocks and increase our ETF hedges, that portion of the portfolio isn't necessarily designed to go net short. Sometimes I mentioned to you, we have put options, and if the put options go deep in the money and the deltas go up, on a delta adjusted basis, we may be slightly net short at times, but it's not, a goal of the fund to go net short during market declines.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.